That typically rely on financing getting a post-rate cut boost today. The iShares software and biotech ETFs both closing higher, and Tesla surging more than 7%, the best performer in the NASDAQ 100. For more on how rate cuts could juice the market, let's bring in venture capitalist Rick Heitzmann, FirstMark Capital founder and partner. He's an early investor in Airbnb and Pinterest. Rick, great to have you. Great to get your perspective here.
Yeah.
So what happens? You're writing more checks now? I mean, what? Your companies have longer lifespans?
Companies have longer lifespans, but the key thing that's going to happen is hopefully this is one of the first unlocks of the IPO market, right? So the IPO market, it lives in fear of risk. One of the risks was interest rates. One of the risks is the election. One of the risks is where's the economy. So a rate cut like this means, hey, the Fed's really serious about where the economy is, and this will spur both enterprise spend as well as consumer spend. In addition, as rates go down, more money shifts into equities. A portion of those equities go seeking risk. Best part of the risk curve, hopefully in the public equities, is IPOs. And you're beginning to see an unlock of an IPO market that's been closed for the longest time since the Great Depression.
Wow. You mentioned, though, 3 risks, and 2 of those risks don't get solved with the Fed cutting rates in terms of the economy and the elections.
Correct. So, but you're starting to see that there's a light at the end of the tunnel, and hopefully that's not a train, that you're able to see, hey, are you going to get to a point where you're going to have an election resolved in 2 months, hopefully, resolved for at least 4 years at that point. So at least you know the rules of the road. And then you assume, given the Fed's commentary, that if this isn't enough, if 50 basis points isn't enough, and no one believes that that's going to be it, that the Fed will continue to cut to push the economy forward, which especially for software companies, which tend to be somewhat long-dated assets as a stock, but also in terms of CapEx and spend, they will benefit on both sides.
So, Rick, you're talking about exits there. Let's go back to the entrance here a little bit. So you have this great track record focused on consumer, but you guys also do a lot of enterprise software and the like. What are you seeing early stage away from generative AI? It seems like every morning, in the Axios bit, it says Gen AI, Gen AI, Gen AI. What else are you guys seeing?
You're really seeing a downturn. Right. So the amazing thing, even though we invest at the earliest stages and we hold for 8, 10, 12 years, so we shouldn't be looking towards the exit environment. But what really shuts it off is our investors, limited partners, foundations, big endowments, universities, need that liquidity from an IPO market or from a good M&A market, which has been a little bit cut off due to especially the FTC in the current regime. Is that you're not seeing the liquidity. Without the liquidity on the back end, there's not as much capital flowing into the early stage, and that's really cutting off that oxygen for the early stage investors.
But in terms of where you are writing checks for at this point, outside of AI, what are the hot areas?
So we still believe that digital healthcare is a big opportunity. And the healthcare has always been a laggard on technology, and now you're seeing healthcare really open up, both in terms of it's the biggest part of the economy in terms of percent of GDP. It's the fastest growing part of the economy, and they're starting to use, even the institutions, technology to better service their customers and patients. The payers are starting to say, hey, I could pay less for a better quality of care, and consumers are demanding it.
Okay. And Roe, you're backer of Roe.
Yes.
We have, so GLP adjacent. Are you doing anything else GLP adjacent or GLP oriented?
We've looked at GLP adjacent. We've looked at GLP oriented. We think it's a mega trend. We think this is going to be something that's going to continue for several years at least. We're looking. We haven't done anything yet, but we think that that's going to pull a whole bunch of things forward, and whether that's knock-on effects in terms of the way people eat or travel or anything else, we're pretty aware of that trend.
So we were talking in the break before the segment started about the early checks that you wrote to Airbnb. I mean, you got in super early. You're saying you wrote 2 $15 million checks, one $38 million check. I mean, early on. And the returns that you've gotten so far. Do you think that in a new, higher, forever interest rate environment where we don't go to zero, presumably, ever again, that you will be able to have those opportunities still, that you can have those massive upside returns?
I think you have, and you've seen it in discontinuous industries. Genentech was the best investment for a long time. I think that was a 1970 investment, still a questionable economic time. Facebook, I think, was 2005. And Jim Breyer and Excel had several thousand times their money return on that, and that was a little bit of a normalized interest rate environment. So you're somewhat tied to interest rates. we had some very good investments in the financial crisis where liquidity was very tight. So there's a supply and demand of capital, which determines pricing in the venture market. But innovation continues, and you're going to see breakthrough technologies, and folks who are willing to take the risk are going to see fantastic returns.